We've gotten more European data in, specifically about Germany just hitting the tape when it comes to retail sales data. Another disappointment for Germany.
That was a shocking set of data. Good morning, Dani.
Good morning.
Minus 6.6% year-on-year versus minus 2.6% expected. Minus 5.3% month-on-month. I think this is a lot of people expecting that there was going to be a year-end boom, even though there was declining economy, slowing growth. There's this idea that the lower gas prices would provide a little bit of consumer confidence into year-end. That hasn't come through in Germany. It's not great for the European story.
Yeah.
And I think this is general backdrop of risk aversion is starting to creep in this week. The price action's not good ahead of our weekend catalysts.
It certainly isn't good. And it takes me to one of the most well-read stories, Joe Weisenthal writing up essentially this argument saying, okay, perhaps inflation, it's not going down in a straight line. Spanish inflation was higher. Australian inflation was higher than expected earlier in the month. We were so positive to start this year. Maybe not we. I know you're always a little skeptical, Mark. But have we overdone it? I wonder if this data just shows us, look, there's more risks ahead. We're not all clear.
Look, I think this whole theory of immaculate disinflation is completely bonkers. I think the only way that we get inflation to come down in the optimistic way that people hope is in line with a painful recession. And at the moment, we're not pricing that. We're pricing in a wonderful world of growth holding up and yet inflation coming down very, very hard. So I'm not ruling out the idea of inflation coming down very quickly. But my base case is actually inflation holds up because the economy is not collapsing as quickly as people think.
I just really foresee this event, or, you know, when we get the Fed actually giving us the interest rate hike. I can really foresee this type of environment where they hike 25 and maybe they say, okay, we haven't conquered inflation yet, trying to talk markets down. But markets just go at their own thing. They say they've done 25, confirming that they're stepping back. We've reached peak interest rates.
You're 100% right that I think that the kind of narrative of the last maybe 6 weeks, 8 weeks is a market that's very much wants to ignore what the Fed wants to do. So Powell might want to sound hawkish. You might want to push back on some of the loosening of financial conditions, etc. But this is a market that wants to see a dovish message. So unless he really shocks, I think they're going to want to see it dovishly. The only thing that's keeping me a little bit nervous about that narrative is some of the kind of the price actions changing. And you're noticing that yields are failing to go lower over the last week or two. And I think we might have bottomed out in 2-year yields. I struggle to see how 2-year yields can fall below 4.1% without a very dovish message.
I mean, but are we going to get any sort of shockingly hawkish message from the Fed? Because there's so many Fed policy members who say, look, we need to wait and see how the impact of higher rates plays out.
I'm still recreating my post-skiing, post-holiday view, so I haven't got high conviction yet. Okay. I'll have it by tomorrow, but at the moment, I don't think they will be shockingly hawkish.
All right, Mark Cudmore, freshly into London, freshly off skiing, still with the slopes on the minds. Remember, you can stay up to date with analysis from Mark and the rest of the team. MLive Go is where you want to head on your terminal.